Yeah, I think we should be all set.
All right, great. Hello, everybody. My name is Brenna McDuffie, so I'm the programs coordinator at Alumni Affairs. So, on behalf of UCSB alumni, I just want to thank you all for joining us this evening for the February edition of Gaucho Academy, presented by American Pacific Mortgage. So, this webinar series features keynote speakers and expert panelists who will dive into topics relevant to our Gaucho community. So today I'm delighted to introduce Jason, who will be leading tonight's home buying workshop. So without further ado, over to you,
Yeah.
Jason.
Thanks, Brent. I appreciate it.
Mhm.
Awesome. Awesome. And it's great to be with everyone this evening. Welcome to, it's kind of a different variation of our home buying classes that we generally teach. It's our housing affordability workshop. And we actually have the second version of this tonight, or the second time I've presented this, because as you can imagine in our teachings all across the country, affordability is on the minds of many consumers across the country. That doesn't necessarily mean just future home buying. It also means existing homeowners that are trying to figure out, how do I afford my mortgage and my property taxes and my insurance, in addition to the cost of goods just being a little bit more expensive. So we're going to dive into both sections of affordability as prospective homeowners and existing homeowners tonight. So hopefully you find this content helpful for you. These sessions that we produce are all interactive sessions. So we would encourage you to ask questions of us tonight. You can hop in the chat or the Q&A function in Zoom and just drop us a question. I'll answer those on air. But we really want to make this an interactive session for you in this learning environment. Again, my name is Jason Maida. As Brenna mentioned, I am with American Pacific Mortgage. So we've been in partnership for the last several years with UCSB alum, and we essentially provide safe learning environments like this to help provide educational tools for you around finances. And so obviously home buying is kind of what we talk generally about, but this one's going to be a little more inclusive to our existing homeowners as well. So we teach virtual classes like this all across the country that are very interactive like this, just to help support our communities around home ownership. Now, we are recording tonight's class, so if you have to step away from your computer, we'll have the recorded version up on our YouTube channel tomorrow. And all the slides that I walk you through this evening, we'll send those back to everybody that signed up for tonight's class. So I know we had a lot of signups. Maybe not everybody was able to make it tonight, but we do want to make sure that you're able to get this content over to you as well. Okay. All right. So that's our plan for the night. Here's our talking points so you can see on screen. So we'll talk about the housing market. We'll talk a little bit about first-time home buyer programs. So those of you that are in attendance tonight are interested in first-time buyer programs. Maybe you're even in California. I'll kind of give you a look at some of those tools that are available to you. We'll talk a little bit about credit and just some areas of opportunity that we like to share as kind of tips and tricks around credit. We'll look at loan programs that are available to you, how those both can help buyers as well as existing homeowners. And on the minds of a lot of us are what's going on with interest rates. Are interest rates going up? Are they going down? What's the talk around that? So we'll kind of share with you some of kind of what we're seeing in the market and our early projections for 2026 levels. We'll also talk about refinancing, and that's for our existing homeowners. But I think for first-time buyers, just to better understand and prepare yourself, what does refinancing mean? What can it do for me? We'll spend some time looking at that. Also talk a little bit about investment properties. Some of you as first-time buyers might be interested in buying your first property as an income-producing property, or for those of you that are trying to expand your real estate portfolio and you just want to look at maybe some passive income sources like investment properties, we'll talk about that. And then finally, we'll kind of just wrap up the discussion tonight, just talking about how you get connected with me to go through a free consultation, which is essentially where you and I will kind of figure out in a one-on-one setting, what does it look like for me for home ownership and putting a game plan together around that? Or is it just simply like, let's assess my current mortgage and where I'm at and maybe where I could potentially save money by refinancing my home? Okay, so that's our plan for tonight. We encourage you to ask us questions while we go through tonight's presentation. And again, we'll go ahead and have that recorded for you, and it's going to be up on our YouTube channel tomorrow. Okay. So in the housing market in California, we're in some interesting times right now. We're still not in the spring and summer buying months, but we soon will be there. The weather's a little bit different in different parts of the country, but the United States, in terms of the overall housing market, has some similarities in the seasonality of the housing market. Usually we see the busier times of the year in spring and summer. Winter, when it's a little colder in most parts of the country, like it starts to slow down a little bit. I will say there's a lot more buyer activity right now in today's market. What I've always learned in this industry is usually after Super Bowl weekend, then you start seeing the consumer interest pick up. So if you see a lot of, clients or consumers essentially reaching out to learn more about home ownership, that means it's probably going to be a pretty busy spring and summer buying season. And I think even before that Super Bowl weekend, we saw a lot of buyers engaging with us in the first of the year for 2026. So, and we'll talk more about interest rates, but I think it is attributed to a little bit about buyers are trying to get into market ahead of the next buyer because of maybe where interest rates are going to go. Now, you can look at the last 3 years of the housing market here on this slide. You can see kind of like we've seen a steady increase, although as of recent, you're seeing some softening in the markets. You're seeing homes stay on the market a little bit longer. That's attributed to maybe overpricing by sellers. That could be maybe the condition of the property. There's a variety of different reasons, but homes are staying on the market a little bit longer right now. We've had some inventory challenges, not only in California, but in other parts of the country. We will probably see inventory levels improve a bit this year. So our expectation is that we'll see inventory kind of tick up a little bit. There are new builders that are trying to build inventory to help make up the gap to where buyer demand's at versus where the supply is at, but still a long ways to go there. But hopefully we'll see some more sellers that'll be willing to put their homes on the market because maybe interest rates are a little bit more favorable for them to get back in and maybe look at that upgrade of a prospective home. Now, for our first time buyers that are considering home ownership and budgeting around home ownership, one of our tools that we encourage you to check out is our rent versus buying calculator. And this is one of the things that I do with our first time buyer sessions that we do throughout the country, which is just to assess like where am I at from a rent perspective versus where do I think I'm going to go from a home ownership perspective. And I did a quick screen share of this calculator. Now, this site actually has some other tools that I would encourage you guys to check out, whether it's affordability, what does it look like to buy down my interest rate? Or for those of us that are existing homeowners, you could do some refinance calculations and figure out, hey, this is where I'm at today in monthly payment. If I have to pay X amount of dollars in closing costs to refinance my home, what do I need to have in savings to properly recoup those investments? And I'll walk you through kind of our rationale around that later on tonight in our discussion. But ultimately, if we were to look at this rent versus buying calculator, and I'll walk you guys through it really quickly here, which essentially shows someone buying a $700,000 home. Well, as a first-time buyer buying a $700,000 home, my minimum down payment is 3%. So that means I would finance $679,000 for that loan amount, right? And if we assumed interest rates around 6% on a 30-year fixed term, that would be kind of the framework of my financing. And then the other assumption we have to make is like, when am I going to buy the home? So we just put March of this year. And then PMI, which we might not have time to dive into tonight, but basically what PMI means is it's private mortgage insurance, which essentially insures the lender against default. So if you as a consumer were putting less than 20% down, then you're going to have mortgage insurance for your home purchase. So we have a factor of 0.37 baked into our calculations. We have homeowners insurance, taxes. If someone's buying a condo or maybe a townhouse, they might have HOA dues for that respective property. So that's all in that line item there. We have assumptions around tax brackets, right? And so that's one of the things that when we think about home ownership that most buyers don't factor into the equation, which is what do my potential tax benefits look like by being a homeowner, right? And so putting your tax bracket in is really important element to this calculator. And then we have the cost of selling my house, the maintenance cost of my home, then the selling cost of my home. So how much is it going to cost for me to have a realtor market my home and eventually sell it? The appreciation rate in my home. So if my home goes up, 3% annually, how much equity do I accrue over that span of time? And then I compare that to someone that's, let's say I'm paying $3,500 a month in rent. So we know a little bit more about on the homeownership side, as I just explained to you, but what does it look like on the rental side? So if we had someone that's, spending $3,500 a month in rent, they have renter's insurance costs plus rental increase hikes. So we assume someone that's going to go up about 2% every year in rental costs, which is not much. What our calculator essentially does is it gives us a side-by-side comparison. So what it'll first do is say, okay, what's your break-even point, Jason? If you're going to continue to pay $3,500 a month in rent, but instead you decide to go out and buy a $700,000 home with that 3% investment, Where's the mark where you break even on that investment? Well, it'll be basically about 3 years by buying versus renting. I generally would want to see our clients breaking even in 4 years or less. So this math would work for a prospective buyer. Now, where I think it's important to understand the huge upside in homeownership versus renting is that when we dig in a little bit deeper and kind of push out the timeline a little further, if I was to side by side compare someone that rents for 7 years at $3,500 a month and it going up 2% every year versus someone that owns a $700,000 home for the next 7 years, that person who owns the home has a $114,000 buy opportunity. So you're ahead of buying $114,000 versus someone that's continuing to basically pour money into rent and probably paying someone else's mortgage. So really that's kind of the magic of home ownership. When we put in home equity appreciation, we put in tax deductibility benefits, especially compared to a rent level like that. That's where a prospective homeowner can really get ahead. And then we look at the overall equity appreciation after 7 years, it's over $250,000. So I would encourage our class, if you have some time, again, we're going to share back all these tools to you. Take some time to look at the rent versus buying calculator. I think you'll find that to be a really helpful exercise as you're kind of figuring out what home ownership could look like for you. And again, for some of our existing homeowners, there is that rent refinance calculator there. That would be a really helpful tool for you as well, too. Now, as you're considering home ownership or refinancing, it's really important to optimize credit score, right? Because every loan program does have a minimum credit score attached to it. And we've spotlighted some of the main core programs here with those minimum credit scores. For some of us that are first-time buyers and you're looking at some of the state agency programs that we offer through California, it's a minimum credit score of 640 for the FHA product, 680 for a conventional loan, unless you're considered low-income housing, and then it's a minimum credit score of 660. In credit scoring, from a lending perspective, we always take the middle credit score of all three agencies that report out. So, the agencies are Equifax, Experian, and TransUnion. They will produce their own individual scores. We take the middle score of all three. So if my middle score or my highest score is 760, let's say my middle score is 740 and my lowest score is 720, we're going to take that 740 credit score as the lowest middle score between or for me as a borrower. If I apply with a partner and their middle score is 700, well, then that 700 score is what's going to be used because we always take the lowest middle credit score between both borrowers. Now, that can impact your product offering, the interest rate, maybe the cost of mortgage insurance. So, it's really important for us to see where the areas of opportunity lie for our clients. And that's things that we can help you with during a consultation with you. Now, when you've had challenges on your credit report, whether that's a late payment, maybe a collection popped up on your credit report for an old utility bill, whatever the case may be, when that impression of that negative item hits your credit report, it's going to have a lasting effect, especially for the most recent 12 to 24 months. Now, we have a matrix that shows you how long those will stay on your credit report, which we can pass along to you. We usually share that in our home buying classes. But if you have, let's say, a late payment, it's going to stay on your credit report for 7 years. But the impact to your credit scores in the most recent 12 to 24 months. So as I move further away from that date of late last payment, then I start to see kind of some organic improvement in my credit score, obviously assuming all of my other accounts are being paid on time. Now, there are three different general models to credit scoring. There is the credit card model, which basically shows up in most of your credit monitoring tools. There's the auto financing model. So if I'm going to run down to the auto mall and buy a car, of course, that model is being used. But on the housing finance side, we're going to use the mortgage model. And so, as you're thinking about ways to optimize your credit score, whether it's buying a house or refinancing at some time, we want to see and identify these areas of opportunity to help lift our credit score, because the difference of a 720 credit score versus a 740 credit score could mean hundreds of dollars in difference in interest cost or mortgage insurance costs, or probably not product selection, but certainly from an interest perspective. So the first component is length of credit. Now that means how long have I had credit? So the more mature my credit file is, probably the higher my credit score is going to be. And then 20% is going to be how much new credit am I trying to bring online? So am I activating new installment accounts or revolving accounts? We really want to limit new credit usage. And we also want to limit hard inquiries that show up on our credit report, especially in the most recent 6 to 12 months. In our process, whether you're evaluating a refinance option or a purchase option, we always start with a soft credit check. And the reason why we do that is because we want to be able to identify areas of opportunity on your credit, but not impact your credit score. And that's what a soft inquiry does. We get visibility to your credit file without impacting your score. Now, eventually we'll do a hard inquiry, but that's a little bit further down the road once we've kind of really determined what direction you want to go with home ownership or even a refinance. Next component is credit utilization around revolving accounts. How much do I owe on my accounts as it relates to the credit limit? Now, one of the tips I like to share in our classes is how you can kind of optimize credit score, which basically means on your revolving accounts, if you can try and pay down your balances before the end of the billing cycle or billing statement date. The billing cycle date is when the credit card issuer sends out all your information to the credit agencies. So if you can get ahead of that notification date and pay down those balances before the end of the statement date, you can get a much higher credit score because you've lowered utilization, therefore lifting your credit score. Last component is going to be payment history. That's pretty self-explanatory. How have I paid my bills? I want to look at on-time payment history to maximize my credit score. If I've had some challenges, let's say a 30-day late on a student loan, I have that rating that could impact my score, especially in the most recent 12 to 24 months. The more severe the credit impact, like a 90+ day delinquency, the bigger hit I'm going to have to my credit score. All right, now one of the things we also talk about, because it does center around credit, is student loans, right? And student loans are one of those things I have conversations around with clients. In fact, I was having one just earlier today around a situation where a client is currently in forbearance, right? So when you're in forbearance, that means you don't have active monthly payments on those student loans. But in lending, we still have to count a minimum payment in qualifying for your financing. So what does that mean? Well, if you were qualifying for, say, an FHA loan, which is the Federal Housing Administration loan, I would have to assess 0.5% of your total balances as the monthly payment for qualifying. So if you had $75,000 in student loan debt and you're not in active repayment, then that would be a $375 payment that would count against your expenses versus your income. Alternatively, if you had a conventional loan, you had the same amount of debt, we would have 1% of the balances that uses the payment. So that would be $750 per month. So we're going to walk through your student loans to see where they're at. If they're in active repayment, guess what? We can use that payment right away. So if you're in a savings plan that's $50 a month on that student loan debt, well, we can use that payment right away. But many of our clients are still in forbearance for whatever reason, and so they're not making active payments. So unless you want to enroll in active payments, that monthly payment that we have here noted as a percent of total debt, that's what we would be using for qualifying purposes. Okay, so I would say, from a student loan perspective, it shouldn't be something that holds you back from home ownership. But we certainly want to help educate you properly on how student loans can impact you from a qualifying perspective. And those are one of the things that we have during a one-on-one consultation with you to design your home buying plan towards home ownership. Part of that discussion also talks about loan programs, and this goes for both our first-time buyers as well as existing homeowners. And so these are 5 kind of core products, if you will. I would say 4 out of the 5 we see more often than others. The first product is a conventional loan. That's around Fannie Mae and Freddie Mac. If you're a first-time buyer, it's a minimum down payment of 3%, all the way up to the conforming loan limit of $832,750. If you're in Ventura County or LA County, Orange County, even Santa Clara County, those are all high cost of living areas, which allows us to extend that maximum loan amount as high as $1,249,000 in certain markets. But with that, when we finance more than $832,750, that minimum down payment that we contribute as a buyer jumps from 3% to 5%. All right. Now, for our existing homeowners, we can obviously look at a conventional loan as well too. It depends on our equity position. When we think about refinancing, whether we're in a 20% equity position or a 10% equity position. But same thing holds true whether you're purchasing a home or refinancing. If you have less than 20% equity, then the mortgage insurance component comes into play. FHA loans are, and I kind of mentioned what it stands for, but it's the Federal Housing Administration loan, has that minimum down payment that you can see on screen, and a little bit more flexibility in our guidelines that we see on the conventional product, down to a 580 credit score. And then the maximum loan amount will vary based upon the county that we want to buy in. Now, both FHA and the USDA product are what we call government insured loans. So they're government backed, this by USDA, this by HUD. There are residency changes that went into play in 2025 for both of these products, which basically essentially require you to be a permanent resident to access either one of these programs. You can be a non-permanent resident and still get access to the conventional loan, but unfortunately, these residency changes were made on both government insured products. USDA essentially stands for the United States Department of Agriculture. So there's remote locations that are eligible for USDA. Zero down payment option is the benefit, a little bit lower credit score requirement. But you do have to meet the location requirement, and there's maximum incomes by the size of your household with USDA. The jumbo loan, not going to be totally popular for our first-time buyers. It's more of the move-up buyer because it does have higher asset requirements for down payment, credit score. Right now, jumbo loans can tend to be priced a little higher than conventional loans just because, jumbo loans are more privatized, whereas Fannie Mae and Freddie Mac, some of the pricing on those loans are set, based upon the institutional price offered through Fannie Mae and Freddie Mac. On the VA side, that's a veteran's home loan, and the VA home loan allows veterans to have access to homeownership with a zero down payment option. You can even refinance, of course, as a veteran, whether that's taking equity out of your home or doing what we call an interest rate reduction loan to lower the outgo of your monthly payment. And the VA home loan has just many more flexible options for the veteran to not only encourage homeownership, but provide maximum affordability, whether they're existing homeowners or new homeowners. All right, so that's kind of a look at some of the loan products that are available to you. Now, with those loan programs, there are minimum down payment requirements that I highlighted just earlier. Now, for those of you that are in California and you're first-time buyers, this is a really important component of affordability is just getting access to resources that can help you kind of reduce what you have to put out of pocket. That's part of affordability as well, too. Not only trying to get that payment down so it's affordable as possible, but accessing resources that can make homeownership achievable for you. So we're right now in the midst of the California Dream for All program. You may have heard that on KTLA or any other news outlet that you're subscribed to. But yesterday on February 24th, the lottery window opened for California Dream for All. That lottery window goes from yesterday all the way through March 16th, and we're currently actively pre-approving clients for the lottery. And as the number one provider of Cal HFA loans in the state, we work with the most first-time buyers across all markets in California. If you're interested in this program, it's a fantastic program. There are some stipulations to it. It does provide up to 20% of your sales price in assistance or $150,000, whichever is less. But one of the buyers involved in the application has to be a first-generational buyer, which basically means a first-generational buyer is someone that doesn't have parents that currently own in the United States actively today, or if their parents have passed, that they did not own a home at the time of passing. Additionally, a first-generational person is someone that hasn't themselves owned in the last 7 years. So great program. We have some guidelines all up on our website that we can share back with you. We are, like I said, actively pre-approving clients for that. We have some really helpful YouTube videos. We did a live class on YouTube last Monday that you can check out as well. And we'll give you some of our social information that you guys can check out later. But that is all under an organization called Cal HFA, which is the California Housing Finance Agency, which is designed to support low to moderate income households in homeownership across California. So whether you're buying in LA County, San Diego, Ventura, Santa Clara, whatever market you're in, this agency can help you around those home buying scenarios. And so I work and partner with them and deliver these different products across the state. So one program, in addition to Dream for All, is called My Home Assistance that provides up to 3% of your sales price in assistance on a conventional loan, 3.5% on an FHA loan. And essentially what we do with this product is we provide a separate loan for you that's at that percentage level, but it's only at a 1% simple interest and does not require repayment until you either sell the home or if you refinance in the future. Now, Cal HFA has other add-on products like the My Access program, which is 2.5% of your loan amount in assistance, or even the Zip Assistance program that can be anywhere between 2 to 3% of your sales of your loan amount in assistance. So a lot of great options to help you. I think as I work with home buyers across the country, but specifically in California, they don't realize that they have access to some fantastic resources available in our state. If you're not in California or if you're not in California, you just want to learn about first-time buyer options in your local community, please get connected with me offline, and we can make sure that we get you supported with the proper tools and resources. We are a nationwide lender, and I work in multiple states. So you might be in Dallas, Texas, and wondering what options are out there. We can certainly help you there as well too. We know the Gaucho communities all across the country, so we can support you with different tools. Pathway DPA is another program that we offer within APM. It doesn't have income limits attached to it. So most first-time buyer programs, you have to make somewhere between 80% to 120% of the median income. Cal HFA, as we spoke, actually that will go up to 150% of the median income for specific products. Okay. So I guess my encouragement for you with first-time buyer programs is there's some resources out there to really close the gap for you to where you think home ownership needs to be. It doesn't have to be 20% down. It could be a lot less, but we can get you resources to make that gap, short, less wide, and ultimately help you reach your goals of home ownership where you thought it might be a 5-year goal. Maybe it's a 1 or 2 year goal. If you look at the application of a assistance program like the Cal HFA My Home, if we take our scenario that we've looked at before, like a $700,000 purchase price, and you had a 3% down payment requirement, well, you could get up to $21,000 in assistance to help cover that minimum down payment. But you also have closing costs when you buy a house. And I always tell clients to budget themselves about 2 to 3% of their sales price in closing costs. And you can also get resources, like I said, with My Access or Zip Assistance that can be used to help offset some of those expenses. So you may have thought you had to save up 50 or 60 or $70,000 to purchase a home. It could be 10 or 15,000, or in some cases, it could be less. Now, here's some of the eligibility requirements for Cal HFA. I kind of highlighted the minimum credit score requirements earlier. We look at a thing called debt to income ratio, which is expenses versus income. You can see that noted here. In our full scale home buying classes, we kind of dive into debt to income ratio a little bit, but essentially is your pre-tax income versus your monthly expenses, which is inclusive of the new housing expense. Most of these programs are for first-time buyers only, which basically means you have not owned a home in the last 3 years. Now, Dream for All is that little stipulation of first generation. At least one buyer needs to be first generation for that particular program. And with these first-time buyer assistance options, they have to be on one unit properties. So single-family homes, townhouses, condominiums. Some BMR communities are eligible, even manufactured homes if they're like after 1976, but they also have to be on land that you own. Okay, and we do see those some in some of the markets, even like San Luis Obispo, Ventura County. We do see some manufactured home options out there. All right, I'm going to walk you through the home buying process now. So those of you that are existing homeowners, you've been through this before, you can probably share your experiences with our audience. I thought I would walk you through this visual tool to help you get a good idea of what homeownership looks like for you. As we teach classes, I always get a lot of like feedback or questions before going into the classes, but where do we go from here? Like after I attend this class, where should I start? And so this is the buying process as it looks like leaving class. So after class, we would encourage you to get connected with me so we can go through like kind of just what does it look like for you in building a home buying plan. That's a 30-minute virtual session that I do with all of our clients to build that framework of home buying. Now, from there, we would go to the house hunting phase of things. So now that we know like what the game plan looks like, you have an idea of your market price, then you would go to house hunting. From house hunting, you would then, maybe get a little more serious on a particular property. You may decide to make an offer on a home. If that offer gets accepted, then you go under contract with the seller. And generally from acceptance of offer to when you get the keys to your house, it takes about 30 days in most markets. Sometimes it can be as short as 14 days. And then you can see these different milestones within the escrow time period, things like the processing and the underwriting of your loan, more the administrative tasks, getting your loan approved. Inside of that, we'll get your house appraised. Your realtor will probably organize some inspections of your house. All of that will happen within the escrow time period. And finally, at step 6 will be the closing of the home loan. That's really the day of celebration, but you actually would be signing final documents on that day, wiring your final funds, and then ultimately getting keys to your house. And that's always a fun day because I get a chance to call you and say, hey, congratulations, you did it. You got to the finish line. You look forward to seeing you in all the pictures in your new home. But we always encourage our clients, like our relationships with our clients don't end there. Part of our aftercare with our clients is to stay connected with them about like what's happening financially for them and how we can support them, just like refinancing, which we'll talk about in just a few minutes. But we also, encourage them to reach out to us when there's questions that come up, a bill that doesn't look right, but also give them tools like our HomeBot system to manage what's going on with home equity, or just keeping them on kind of our rate watch monitor to make sure if rates hit a certain level, let's start talking about refinancing. Okay, so that just gives you a kind of a sense of the buying process. Now, that's probably a good segue into interest rates because, once you purchase your home, we're still going to be monitoring the rates because our relationship doesn't stop there. Because if we, buy our home today at 6%, well, if rates get to 5%, now we want to start maybe having the conversation around let's maybe talk about refinancing and how much money can we save on a monthly basis. Now, whether you're looking at the entry point to homeownership at a certain interest rate level or you're thinking about refinancing an existing home, I think it's important to understand where we're at today from a rates perspective. Where have we been, which hasn't been the greatest, and where do we think we're going to go, right? So this is a snapshot of the last 3 years of interest rates. Let's kind of pay more attention to the 30-year fixed mortgage rate, which that's what most of us will be doing. You can see the kind of the tip of the mountain here was August 23rd. Interest rates inch closer to 8%. I know I was in Palm Springs that day when it happened, and it was quite an interesting day because I was like, okay, what is happening in the markets? But that was short-lived. You can see rates kind of came back down a little bit, but all in all, over the last couple of years, we've been in the high sixes, maybe 7% range. We finally have touched down at basically 2.5 year lows as of late. We're just hovering right over on that 6% level of interest rates. We're probably going to stay around this area, but I think we could inch closer to the 5.75, maybe 5.5 by year's end. We're obviously watching closely what the Federal Reserve is saying about interest rates and where they're going to go. But we do expect better affordability all in all this year just because of the lower rate environment. I mentioned it earlier, as interest rates go lower, buyer demand picks up. And so many buyers are just trying to beat the next buyer to the market by getting in and hopefully purchasing before more competitive offers are out there, more buyers and population are active in the markets. Now, with interest rates, they're not the same for everyone. So whether you're purchasing a home or refinancing, I think it's important to understand how do you maximize interest rate? Well, credit score eligibility plays a role, and we talked a little bit about credit tonight. So if I can go from a 720 score to a 740 or 740 to 780, my pricing matrix will look a little bit better. Loan program will change. So if I'm doing an FHA loan versus a conventional loan, that could change what my rate determination is, how much I finance, what my equity position is, whether that's in a homeowner or how much I put down. I'm putting 20% down or I'm putting 10% down, the pricing will look different between those different products for the client. Sometimes buyers will elect to do rate buy downs. Not a huge fan of it, but if we're trying to really improve affordability on a monthly scale, that can be one way of doing it. Usually a point means 1% of your loan amount, and we equate a 1 point to about a 0.25% reduction in interest rate. And then another way you can lower the cost of your interest rate is to shorten the term. So if you wanted to look at a 30-year loan versus a 15-year loan, that's probably about a 0.5% difference in interest rate. But you also elevate the cost of your monthly expenses, right? So most of our first-time buyers were probably electing a 30-year loan just to help kind of manage a better level of payment. But you may be an existing homeowner that's in a really great equity position, very low mortgage balance, and a 15-year loan looks pretty good for you. Not to say you still can't pay down your mortgage like you're doing a 15-year loan or a 20-year loan. You can always accelerate principal payments on these loans. As I get a chance to meet with clients, we're going to kind of figure out what the right design of your financing looks like. Just like I mentioned during our home buying process segment, we're going to figure out the right kind of game plan for you around home ownership or even considering to refinance a home. This is just a quick little forecast of interest rates. I thought I'd share back with you guys kind of where we think interest rates are going. You can see, I think this might be a little conservative, but, going sub 6%, pushing into like 2027. I think we might get there a little bit sooner, but I think ultimately we're going to be watching what the Fed has to say around inflation, how much progress we're making on inflationary goals, and what do the labor markets look like. And this is truly a global economy, right? So we're watching what's happening in Europe. We're watching impacts of, potential tariffs that we saw that were forthcoming. But really the two measurements that the Fed's looking at is what's inflation, how's it going? Are we reaching our 2% goal of inflation? And what's the strength of the labor markets look like? So the 10-year treasury, which is always a good barometer of what's happening, is hovering around 4.03 right now. If we can go under 4, we should see rates move on the leg lower. So 10-year treasury is always a good kind of measurement to see kind of what's happening and how that is reflective in mortgage interest rates. So let's spend some time now talking about refinancing. I think this is not just important for existing homeowners, but I think planning for your future is future buyers. I think it's a really great opportunity to understand how we kind of see refinancing, because it is going to start to pick up in the refinancing world. There's a huge kind of backlog of clients that are waiting for rates to just tip just below 6%. So it makes good financial sense for them. But we should have goals to keep in mind when it comes to refinancing, whether that's reduction in interest rate, which would equate to a reduction in monthly payment. We could have a goal of reducing the term or overall repayment of my loan. So I want to maybe pay less interest, but accelerate my principal payments. I may have a situation where I want to invest in my child's education. I want to take equity out and pay off student debt or pay towards student expenses, or maybe I just want to make some improvement to my home. All those can be used through home equity. Sometimes we might want to tap into that equity by using what we call a home equity line of credit. So a home equity line of credit usually goes up to 90% of the fair market value of my home. So let's say I have a house that's worth $600,000, right? And I owe $300,000 on it. So right now I have $300,000 in equity. Well, a line of credit may allow me to tap into that $300,000. So I could probably maybe access $140,000 or $200,000 of that equity, and I can use that to fuel my need to handle expenses. Maybe it's to pay off credit card debt, whatever the case may be. When you think about refinancing, some general kind of ways that we look at are kind of our philosophy on refinancing, because not all lenders look at it this way. And as a leader in homebuyer education, we really feel like it's our duty to make sure that our clients that do choose to refinance are in a better position than they were before they started the refinance. So one way that we ensure that is we want to see at least a 1% reduction in interest rate. So if today I'm at 7%, I want to at least drop my interest rate by 6%. We do see oftentimes where lenders, especially in the refinance space, that are showing just non-achievable interest rates. So they're showing you rates that just don't exist in the marketplace, but doing a little bait and switch, if you will, showing a 5% interest rate when the average interest rate is 6%, but not showing you the expenses that it takes to get to 5%. Trying to earn your business by showing just the interest rate, but not the expenses behind the scenes, like buying points to achieve that interest rate. So I would just say be on the watch for that. And that includes clients that are buying a house too. We see that oftentimes. So don't believe just what you see online, because it may not be all that it looks from the initial go. So especially when you get on things like bankrate.com and some of the ways that you can search rates, you can find whatever rate you're looking for, but it's really important to see the expenses that are associated with that respective rate. And generally, when I build financing scenarios for our clients, they include no points, because I'm not, right now in today's market, I'm not a big fan of, paying points, because it takes about 3 to 4 years to recoup those investments. So if I'm going to pay 1% of my loan amount to get enough savings out of that 1% expense that I'm going to put out of pocket, it's going to take me about 3 to 4 years to break even on those expenses. Okay. All right, now we're going to talk about investment properties. I do get a lot of questions from first-time buyers and existing homeowners about expanding their real estate portfolio. Before I do that, any questions so far from the audience that I can answer for you? And like I said, I have the chat and Q&A open, so you can just throw it in either one of those windows, and we'll take a look at it. But I want to make sure that we answer any questions that you might have. And for those of you that joined late, we are recording tonight's class. We'll send out all of the presentation material tomorrow to you as well. Okay, if we don't have any questions, let's talk about investment properties. This may be something you're interested in or not, but I think it's important to understand whether you're buying a 1-unit property, 2, 3, or up to a 4-unit property. There's different ways to structure that. If you're trying to live in one of the units and then rent out another unit, that's certainly allowed. It'd be a primary residence purchase. And then, kind of as a house hack, if you will, then you're trying to get the other rental income to offset or augment what your outgoing expenses look like for the mortgage. Now, multi-unit properties and investment properties will have higher interest rates. So Fannie Mae, Freddie Mac has adjustments in the pricing modules when you are going to add on additional units to, your purchase scenario. So to go from a 1 unit purchase of a single family residence to a 3 unit purchase, that may adjust your rate, 0.5 to 0.6% in interest rate. So there's obviously going to be a little bit of trade-off, but there's an investment opportunity for you as well. Now, if you're going to buy a investment property and not live in there, it's generally going to require at least a 20% down payment, and that also includes a higher interest rate as well too. If you are going to buy a multiple unit property, but you do plan on living in the property in one of the units, so let's say you're going to buy a 2 unit property, you live in one side, you rent out the other side, the minimum down payment on a conventional loan is 5%. Minimum down payment for an FHA loan is 3.5%. Okay. When you think about house hacking and doing his owner occupied financing, we need to kind of really figure out what your goal is there, because is it to try to accrue a bunch of equity, which is probably going to take you several years to get enough equity out of the house, and then use that as a building block to the next purchase? But if it's to augment the cost of your home, to create, passive income, all those are things to obviously think about as we build your home buying strategy. But house hacking allows you to keep, building equity, but then avoid having to pay that higher down payment. So it's a strategy that I see in more of my higher cost of living markets, but you have to keep in mind, if you're going to buy a multi-unit, let's say you're trying to buy a 3 unit property in LA County, well, guess what? That's also going to come with a higher purchase price as well too. So it's not an entry point of $700,000 for a single unit. Maybe it's an entry point of 1.5 million. So now once you get above 4 units in property, that is called commercial properties. And I don't handle commercial real estate. So we do have a partner within APM that handles that. But any type of institutional financing like Fannie Mae, Freddie Mac, FHA, those all go up to 4 unit properties. Okay. So I like to kind of share that with you. It's not typical that we'll see a lot of first-time buyers or maybe even existing homeowners purchasing investment properties, but I think it's important to understand what those options look like. Now, whether you're looking to dive into homeownership from that perspective, or buying your first-time home, or trying to save money through a refinance, I'd love to be able to get connected with you after today's session. If you want to learn about how or what affordability looks like in your own finances. If you have some questions and just want to connect after today's call, maybe it's a question that you have about your finances, we can set up an introductory call. Our scheduling link is here on this slide. But if you want to dive a little deeper and kind of build a personal home buying plan or a refinancing plan, love to do a consultation with you. That's a free service that we do for all of our communities that we serve across the country. It does require you to do an online application. You'll upload some documents, and then same kind of process. You'll just schedule a either virtual or a phone consultation with me, so we can kind of figure out what that plan looks like for you. And for the first-time buyers, a consultation outlines kind of all these important kind of items. Where do I want to buy? What's my budget look like? What are the type of properties I'm looking at? How much can I afford to put down? Am I ready right now? Do I need to make some adjustments in credit? And can we help kind of coach you through that? Or maybe we need to put together a savings plan to help get to the level of down payment that you need to achieve in order to make that monthly savings affordable for you. Okay. So those are all the things that we'll talk through in our consultative service. Part of our partnership with our Gaucho community also includes discount in our services. So we'll discount our closing costs for you. We try to provide, competitive product options for you from an interest rate perspective. And you have access to first-time buyer programs. Of course, our whole catalog of educational classes that we have throughout the year. And we are a trusted resource for you in home buying or refinancing. And so obviously there's a lot of different choices out there in the lending space, but as kind of most of our testimonials and partners will attest to, we really lead with care and compassion for our clients, because we understand whether this is, your first time buying and it's your biggest financial decision, or you're an existing homeowner and you want to make a smart financial decision. We understand that, and that's where we want to make sure we're here to help support you. And we'll tell you if it's not the right time to do either one of those things, or maybe it is, and let's explore that together. We also have an expanded network of partners that we work with, we have on screen. So if you have friends, family, or coworkers would enjoy this class around affordability for homeowners and first-time buyers, or our full-scale first-time buyer class, we'll teach over 10,000 community members on home ownership and affordability throughout this year. So we'd encourage you to have them come check out our classes. Our full list of classes can be found at mortgageeducate.com. Here's all my contact information. So if you do want to reach out to me, feel free to message me or call me. Love to be able to be a resource for you. And our socials are a great way to kind of find out what's going on in home ownership and kind of just learn what's happening in the market or hearing what people are saying about us. We'd love for you to kind of follow us on Instagram or kind of even see what's even people are saying us in some of our Reddit communities. We love the feedback we get from our local communities that we support. So that really brings us to the end of our affordability class. I know we've had everybody stay in the class for the entire time. I really appreciate everybody being so attentive in tonight's class. I haven't got any questions, but I'm more than happy to take on questions for tonight's class before I turn it back over to Brenna. Any questions from our class tonight that I can help answer for you on some of the concepts and ideas that we kind of walked through tonight? Oh, okay. Thank you for that. Okay, cool. All right. Okay, well, I hope you enjoyed tonight's session. Hopefully, this is something you can take away, one or two concepts that can help you improve your own finances, maybe lead you down the path to home ownership, or help you kind of maximize saving as an existing homeowner. I hope you guys have a great rest of your Wednesday evening. Have a great rest of the week, and I look forward to connecting with all of you soon. Have a good night.